Let's welcome Daniel Lacalle, Chief Economist from Tariffs, to the program. Dan, always great to speak with you. I'm really looking forward to this conversation. Let me kick off with the comments we just had from the Fed's Barkin around the U.S. consumer right now, because it feels like this is so central to the trajectory of the U.S. economy. He's warning that the U.S. consumer is already frustrated with inflation, already frustrated with high prices, and they're not going to want to absorb the costs of these new tariffs. The Trump administration seems to think otherwise. What's your view?
Thank you so much, Juliana. I think that it's very likely that the consumer starts to hurt even further in the next 2 to 3 months, because it is absolutely right. Credit card debt is at all-time highs. Consumers have been trying to absorb the rising prices as much as they could, but it's also very, very difficult to sustain that level of consumption growth in an environment of persistent inflation. Therefore, I believe that that is the reason why Fed officials are saying that they don't see much of a risk in inflation, because it's going to be very challenging for for producers in general and for distributors to pass the effect of tariffs to final prices, at least in aggregate prices. It may affect some individual prices, but aggregate prices, which is what CPI measures, going to be rather difficult. I think that we're seeing, for example, how Walmart is already putting a lot of pressure on Chinese providers and suppliers to absorb the entirety of tariffs. So that may be a reason why Fed officials don't see much of a risk of inflation, but we need to be more concerned about growth, probably, than inflationary pressures.
Really interesting there. So more concern about growth than inflation. And it sounds like you would agree with that view, that the real risk when it comes to these tariffs is not on the inflation side, but on the growth side.
Yeah, I think that we probably have discussed quite in detail the likelihood or not likelihood of tariffs impacting inflation. There's a lot of analysis made about it. However, there is probably a very optimistic view about tariffs and economic growth. Tariffs do impact, for example, trade, and certainly investment, and will probably have a significant impact in those economies that are going to lead global growth in 2025, because they're also the biggest exporters. So we need to pay attention to that, because I'm not so concerned about the risk of inflation, but certainly what we may get is a negative impact in terms of GDP growth. We have already seen 2 negative revisions of global GDP growth. There may be another.
What about for Europe? How are you thinking about the growth and the inflation impact of these new tariffs? Obviously, bearing in mind that one of the major impacts may come from the retaliatory efforts from the EU, which we obviously don't know what those look like yet.
Yeah, you've mentioned something that I think is absolutely critical. I think that the market has made a correct assessment of the risks of tariffs, but they have not at least priced the level of retaliation from some economies. It is true that the European Union doesn't have a lot of ground to impose retaliatory measures, because obviously the trade surplus of the European Union with the United States is so enormous and has risen so dramatically that it's challenging. But we cannot rule out that there will be retaliation measures. So I think that that is where we need to start to sort of put limits on our estimates for the next 3 to 5 months, is to be at least more aware of what is going to happen regarding this negotiation. Tariffs are ultimately viewed by the Trump administration as a negotiation tool to level the playing field. However, we cannot rule out the idea that many governments will feel threatened and will not want to accept a negotiation and simply decide to enter into a trade war. I think that those are the elements to take into account in the next 3 to 5 months.
Dan, let me just push back on this view that tariffs are a negotiating tool from the Trump administration, because there's a lot more debate now that they're not simply a negotiating tool, and he's not operating in his usual transactional fashion, but actually the Trump administration is going for much more radical, long-lasting change, a real paradigm shift here. And specifically, there's a lot of talk about the Mar-a-Lago Accord, which has been inspired by the Plaza Accord back in 1985, aimed at devaluing the dollar. Do you think that's the correct lens through which to view these tariffs? And if so, what does a weaker currency mean for the U.S. economy?
I think that the level of aggressiveness of the tariff decision is going to depend a lot on what other nations are going to accept in terms of continuing to use the US dollar and continuing to use the financial system of the United States and trading with the United States in a more balanced way. I agree with that. However, I think that the idea of artificially devaluing the currency in order to boost exports is so misguided, and it's never worked. It never worked. It didn't work in 1985 either, by the way. You have to remember that artificially devaluing the currency may have a small impact for a very short period of time on exports, but it's going to make imports rise dramatically. Furthermore, it's also that does lead to inflation, because it means higher money supply growth and higher money velocity. So we need to be very concerned about those sort of magical ideas that devaluing the US dollar is going to balance trade and make everything great. If it may have a very, very short impact in terms of exports, but it's going to be absolutely atrocious in terms of inflationary pressures, as obviously the loss of purchasing power of the currency. And we have just talked about how dangerous the situation is for consumers to put more inflationary pressures. And those actually are longer lasting. If you immediately impose a devaluation of the currency, that does not last for a couple of months.
Daniel, let me ask you about gold before I let you go. Gold has put in its best quarterly performance since 1986. I know you've been out there talking about gold as certainly as something that we could see continue to benefit from demand from central banks and continue to rally from here. How much further does gold have to run? Just lay out your thesis for us.
Well, I see three elements that strengthen gold prices in the next months. The first one, obviously, is central bank purchases. A lot of central banks all over the world are buying more gold because they need a stabilizing factor in their asset base, and also because they're reducing the percentage. They're not eliminating it, but they're reducing the percentage of treasury bonds or European bonds in their asset base. Number two is the fact that supply and demand is exceedingly tight and is not getting any better anytime soon, because mining is very, very challenging. And the third one is precisely what we've been discussing prior, is that the market is basically now discounting that monetary destruction, that central bank easing, that continued money supply growth is going to be a persistent element of destruction of purchasing power of fiat currencies. Therefore, gold and silver are being sort of true hedges that historically belonged to fixed income, but fixed income is not doing it because obviously it is hurt by persistent inflation and therefore lower real yields.
Daniel, always a pleasure. Daniel Lacalle, Chief Economist at Tariffs. Thanks so much for joining us on Street Signs this morning.